I'm Eileen Lessert with Better Homes and Gardens Island Lifestyle here on the Big Island in Hawaii. Today we're going to talk about first-time buyers and how they can get their home. And with me today is Jim Allen from Guaranteed Rate Home Mortgages. And Jim's going to go over the different programs that are available to first-time buyers.
Thanks, Eileen. And there's a lot of options for first-time home buyers. There's an FHA loan, which the down payment options start at 3.5%. Allows for a non-occupying co-borrower. So if the kids are having trouble or trouble qualifying, they can use their parents' income to qualify without occupying the property.
Don't tell my kids that, okay? Just saying.
The down payment and closing costs can be gifted. And then there's some myths with first-time home buyers is that you need a 20% down payment, you need to have stellar credit, and those are not true. You can do this loan as low as 3.5%. Some loans as low as 3%, and then there's also 100% financing through a USDA program, but it has to be in a rural area. And on the island of Hawaii, or the county of Hawaii, pretty much the only places where you can't do a USDA loan is in Hilo. And it's based off of capita per.
Oh my goodness, that's
so
crazy.
The proper, pretty much the Hilo around, there's certain areas, and there's a map
where they could use the loans the most.
Right, but if you go out into Keau and other areas outlying Volcano, they're all going to be eligible. It's a good program.
What about Kona, Kona Town?
Kona, you can do it, Kona, yeah. It's kind of, you would think that you wouldn't be able to, but again, the USDA...
Why did I think there should be logic with the USDA loan?
But it's based on...
I lost my place.
It's based on census tracts, and it's based on what the density of those census tracts are. So Hilo has more people within those tracts than Kona, where it's more spread out. So it will qualify, and you can do a USDA loan up to $822,375.
Which is almost double. What a FHA loan is.
FHA for a single unit is $408,250.
There's no logic in these government programs.
And the way that FHA comes up with the maximum loan amount, it's countywide.
Yeah.
So it includes the sales in Pahoa and
Puna
and all other areas of the island. So that has a tendency to drive down what the overall median price is. Whereas if you were to do this just within Kona or West Hawaii, that would probably be a higher limit, but FHA won't break it down by individual.
Interesting, because of the time we're filming this, the median price in Kona town itself right now is $1 million.
Yeah.
So an FHA loan at $480,000
no,
doesn't make sense.
It's not going to work. You may be able to get condos, but then you got to get the condo approved, and that's a little bit more difficult with FHA as well.
So the craziness of it all is you could get a USDA loan in Kona.
Yes.
And the loan limit is almost double.
Yeah, and the difference with USDA is that there are income restrictions.
Right.
So you can't make more than 80%. What is it? I think it's for a family of three, not 100%, but it's around $100,000 a year, which doesn't get you to an $822,000 loan amount unless you have more in your family size, and then that income limit will go up.
Wow.
Yeah.
Okay.
So it's the one loan that when I look at the underwriters and go, no, they don't make that much money. The reverse of everything else, right?
Yeah. So, they make too much money for that loan.
But it's a good product. The other thing that's a little bit more restrictive is that the debt to income ratios are lower because it is, again, 100% financing. But we've done them, and we can still do them. And it's a good program for the right people in the right circumstances.
Yeah. And I just want to point out, for first-time buyers, it is important to work with a professional like Jim, because you need to know all your options, because there's so many different options. I can't tell you how many people I mentioned the FHA, what do they call it, bridal registry loan, which is basically your friends or mostly your family, I think.
Give you gifts.
Give you gifts of money. I did a whole session on this. I called it GoFundMe, I think I called it, the video, about having your family gift you that down payment. And of course, it has to be a gift. It's not a loan. It's a gift. But many times, why I think that's so important is when I look at what first-time buyers are paying for rent, it's due to our interest rates today, their rent is much higher than their monthly outlay would be if they were buying a home. I don't understand. I mean, I own rental properties in different states, and in one place, I look at my renters and I think, why are you renting my home for $1,500 a month, and you could be buying that home for $600 or $700 a month? I don't understand, and I try to push everybody I can.
Well, I think it's just education. And
it is education.
And there's a lot of myths about owning a home. But the first step, whether it's first-time home buyers, second homes, investors, is really to get qualified if you're trying to get a loan. And for first-time home buyers, it may not be that they're going to be able to buy right away. But we're not going anywhere, right? We're going to be here for a long. I mean, there's. So, I'll take the time to go through them and give them an idea of what they could qualify for or what they need to do to get qualified. And then explore all their options. Like, a lot of people don't think that they should ask their parents for a gift. But a lot of parents may have the ability to do that, and they want their kids to succeed.
Who doesn't?
And you're finding it harder and harder to
Who
find something.
doesn't want their kids out of their house?
Yeah, well, that could be it too, right? To get them out of the house.
You mean I can pay you to get out of my house? Deal.
So with most programs, with FHA especially, is that a gift is allowed. USDA, a gift is allowed. Even on a Fannie Mae conventional loan, gifts are allowed. So that's one of those options that we'll go through. Now, if credit, if their credit is really bad, we can work with them to figure out ways to improve their credit. There's no places that they go to that they say that they're going to fix your credit.
Yeah.
If it's your credit and it's your lack of making those payments, there's nobody that can magically make that go away. But there are things that you can do to improve your credit scores, and I'll go over that with them as well, in meeting with them, and then go over what they would qualify for. And people are really surprised at how much they can qualify for once they get in and start going through the numbers. But until you're going to be locked out of it. You're going to always be wondering.
Again, back to the education, because so many first-time buyers that I've dealt with over the years is, oh, my credit's too bad. Well, let's fix it.
Yeah.
Let's fix your credit. You mean you can fix it? Yes, you can fix it. You can. There's a lot of things you can do. Bottom line is, it was your responsibility to pay your thing. But let me bring up, for example, medical. A lot of people say, well, my credit's ruined because of medical. Well, there's ways you can work around that.
Yeah.
Right?
Yeah. The medical is something that's a little bit different. It's not something that we would count and factor into the ratios, but the medical still has a tendency of driving the scores lower.
Yep.
So, and anytime you have collection accounts, you need to get those cleared. You don't necessarily have to pay them off, but that will affect your credit score. And if your credit scores start going under 620, with FHA and VA, you can have the scores go a little bit lower on certain circumstances. But again, looking at what your credit is, it's eye-opening. And people don't realize that the collection accounts, they refile the collection, right? After
it doesn't go away.
After so many times, it'll get sent to another collection agency. Somebody will sell it.
Yeah, they
for
sell
less.
your debt.
They sell your debt, and they'll sell it for 60% to somebody else, and they'll try to collect. And when that gets reported on your credit report, that's going to drive your credit scores lower, even if you're making all your other bills and all your other payments on time. And the best thing about credit is if you have credit and you've had challenges, is to make payments on time. Because if you have challenge or credit history is not so good, and you're trying to do good, and you go for 6, 7, 8 months with making payments, and then you have that one missed payment, that will really cause your scores to go back down again and kind of start all over again.
Yeah.
But until you sit down with somebody that can explain to you what the home buying process is and allow you to qualify, sometimes you're pleasantly surprised. Other times it just may not be that you're ready to buy right now.
And there have been times when I've pulled up my credit score and seen things that aren't even mine. So don't go just by what they say your rate is, look into it, because a lot of times there's somebody with your same name.
And mistakes can be made,
yeah.
and it's always good to monitor your credit with identity theft that's out there
Yes.
too. That's another reason why you want to monitor your credit. But sometimes things are reported in error, or the creditors that are reporting it reported in error. So it is a good idea to always maintain. And there's a free credit report that you can get.
Today you can get free credit reports. It didn't used to be that way, so it was a mystery. You didn't want to pull your credit report because it would show on your credit. Now today you can pull your own credit report.
And there's a lot of things that are happening now with your credit scores, where you can go to your bank, credit card companies, and they'll provide your credit scores. Those scores aren't the scores that we use when you do a loan. It's a different model that we do when we pull them. So it's not common, well, my credit score is 780. Why you have it at 720?
Yeah.
And I go, well, go to your credit card company, see if they'll give you a mortgage. But it's just a different score when they do it. And then we use 3 credit scores, and we take the middle of those 3 scores is what we use to do the loan.
You have to work up to it a lot of times. So I might sit down and counsel them and say, okay, find out where their issue is. If it's credit, okay, it's going to take us 12 months, you guys, to clean this up on your credit. So in the meanwhile, let's do this and let's do this, and maybe we can get your car paid off in that time, in the next 12 months, and so on. So you may not be able to go out and buy a house that day, but we can have a goal and a plan to, and if you are thinking about buying a house, don't go out and buy a new $40,000 pickup, because you can't live in it. I'm just giving you some advice here. You cannot live in it.
Like, really, there are a lot of people that think you have to have a 20% down payment.
That's it, yeah.
So saving for a 3.5% or 5% down payment, is very reasonable.
It is, yeah.
There's mortgage insurance, but yet that gives you the ability to buy something now as prices continue to increase, so you can get into your home and be able to benefit from that appreciation, even though you have to pay the mortgage insurance, which will stay on until you get to an 80% loan to value.
Right. And today, that could be quick.
Yeah.
Somebody who bought a house 2 years ago could already maybe be up to that point.
Yeah. Removing the MI is a little trickier. It's not just solely on the house appreciation. It's going to be based on either paying down the principal or improvements that are done to the property. But you could always refinance.
Right.
And at that time, you'd be able to go based off of the new appraised value.
Right.
But it's different for investors and different for different types of mortgage insurance. But it gives, the lower down payment options does give you and does benefit more and more people to be able to get into a home.
I just read recently that, is it Fannie Mae is now going to count if you pay your rent on time. It was something new that they're building in, and I always wondered why that wasn't something that they looked at.
Well, rent is always considered when you're in, putting 3% down or 5% down. They look to verify that you pay your rent on time, because sometimes that's the best judge is paying your rent on time. So, but that's just in part of the qualifying. And then the other thing that you want to do, if you're a first-time home buyer, never owned a house, is that you want to not pay your landlord in cash.
Yes.
Because we need to be able to verify the down payment. We need to be able to verify the payment of the rent. And if you're not doing it to a property manager, we can't call the owner, or we can't verify with the owner that you're paying cash, because we don't know where that cash came from.
Right.
So that's another thing. If you're looking to buy a house, you want to be able to keep track and write a check so you have proof of the payment. And then some programs will run, because everything is run through, when you're doing lending, everything is run through an automated underwriting system. And sometimes they'll waive the automated underwriting system, will approve the loan without having to verify rent, but it's just on a case-by-case basis, looking at the overall risk of that file.
Something I always, when I'm giving first-time home buyer seminars, I always say, the worst thing you can do is, okay, you have your loan approval, you're in escrow on a house, do not go out and buy new furniture on credit. I can't tell you how many deals I saw fall apart because they qualified, they're in escrow, now they go out and buy all this furniture on credit, and all of a sudden they don't qualify for the loan anymore. So don't buy anything while you're in escrow.
I have a story where a guy was he was getting married and he buying a house for them to live, and he bought a very expensive diamond ring.
I knew you were going to say
as an
that.
engagement ring, and
On
then
credit.
on credit, and literally he did it with a very short-term repayment, so his payment was larger, and we actually had to go back and have him renegotiate the terms so it would be a longer period so he can qualify. So yeah, those are the things you don't want to do, because I mean, once you get the house, you can buy all
After
these
it
things.
closes escrow,
Yeah.
you're golden. But not that I suggest you go out and buy furniture on credit after you close either. But don't do it at all when you're in
Before.
escrow. I mean, it's
And try not to change jobs. That's another one,
Yeah.
because that creates us having to
no matter how
re-verify
much
the
you hate
job.
your boss, hang in there for that
Yeah,
60 days.
Wait for it to close.
Yeah,
and
yeah.
then give them notice.
Yeah.
But
I know you have more programs besides the FHA and the USDA for first-time buyers. What are those?
yep. We also VAs can be used for a VA loan can be used for first-time home buyers if they're eligible and they have their certificate of eligibility through the VA, and that's 100% financing up to $822,375. And the process with VAs, there was a theory that in the past the seller had to pay certain fees.
Yes.
Guaranteed rate doesn't charge an origination fee, and by not charging that origination fee, there's no fees that the buyer is ineligible to pay other than the credit report. So only fee a seller needs to pay on a VA transaction is the credit report, which are $200-300. Qualifying wise, actually the ratios on a VA can go up to, I've seen them as high as 59-60%, which is it's a lot more than what a conventional loan, which would be probably max of 50%.
Yeah.
So you can
VA
go-
loan is, fortunately for our service people, is such a blessing. And my experience over the years is that VA does everything they can to get that vet into that home loan. That makes me think of the time when I had the one client that had so many medical bills, and they literally just said, okay, well, that was whatever that instance was, and many times people don't think of VA in a condominium,
Yeah.
and they're one of the not easiest, but they work with you. They'll
If the condo documents are provided to the VA, they'll review it, and they really want to be able to approve it. And they have different requirements than doing the loan through Fannie Mae and getting them to approve the condo.
yeah, which is a nightmare. No,
Yeah, so right now it is.
Yeah.
But so that's a good option as well
Yeah.
for a VA.
this particular office that we're in today of mine is in a resort. Veterans it doesn't occur to them that they could buy in a resort for their VA owner-occupied home. And I've been astonished how painless it is to get these complexes approved through VA, and they can live in a resort.
Right,
And their loan limits are better.
right. You get higher loan limits. And a veteran, guaranteed rate, we do a lot of VA loans, and it's one of the things we pride ourselves in doing. And even the program that we do, it's called Homes for Heroes.
Homes for Heroes, great.
And that's
yeah.
how when we set up the loan, that's what the program is called. And it's a VA program, but it's still 100% financing. We love to get veterans in
Yeah,
to homes.
That's a soft spot for all of us.
Yep. And then for first-time home buyers, you still can go a conventional
Yeah.
loan. And so if you don't have, like FHA has the lower loan limit, you can do a conventional loan with, it can be as little as 3% down, up to $822,375.
So basically, everybody thinks FHA for the first-time buyer. Here in Hawaii, that's not so much because the loan limit's so low. But
Well, not only is the loan limit so low, you have to pay mortgage insurance for
Right.
the life of the loan.
Right.
And there's an upfront fee that you have to pay. It gets financed, but that monthly MI doesn't go away. And that makes the program, to me, you have better options. The thing with FHA you would use if you have lower credit scores maybe,
Yeah.
or if you need a non-occupant co-borrower to help qualify.
And
But
let's
a
talk about
conventional
that
loan-
for a minute.
Yeah.
On the FHA loan, you can have a parent co-sign on that, correct?
There would be a non-occupant co-borrower, and what we would do is we would look at the borrower's income, the person buying the property's income, and the parent's income, or related member,
Yeah,
a related family member.
Yeah, doesn't have
Has to be related, can't be Hanai, everybody's Hanai here in Hawaii,
Yeah.
so, but it'd be related, and they can qualify, so we would take what their income was and what their liabilities were, combine them, and as long as those debt ratios are within the guidelines, we'd be able to approve the loan.
You just can't find a home
Yeah.
in the price range that the loan limit is, so.
Yeah, so as an example, you can have people that are making, $1,000 a month, and they really can't afford the payment, but have the parents be co-borrowers, and we'd be able to get them qualified. Now, making the payment, obviously, if you're going to be a co-occupant
Yeah.
co-borrower, or a
You're-
non-occupant co-borrower,
You're
you're
responsible.
You're responsible for the payment,
Yeah.
right? So, you want to make sure that they're able to pay their share of that mortgage payment.
But then, so people think of a lot of times going with the FHA loan because of the 3.5% down, but really, for us locally, the conventional loan is actually
It's better.
better.
And there are options for 3%. And again, at a 3% down, you can't have poor credit.
Yeah.
You're going to need to have better credit to do 3%. 5%, the more you put down, the more flexibility there is. But at 5%, which is 1.5% more than what you could do with an FHA, and the mortgage insurance will go away at some point without
Yeah.
having to refinance. And then you don't have to pay the upfront fee.
Besides the lower fees, the biggest advantage to me is that FHA is what did we say? The loan limit is in the 400s.
408,000.
And then the conventional isn't it almost double?
Almost double.
Yeah.
Actually, a little more than double.
Yeah. So
So,
that works better for us here in Hawaii. For
408 versus 822.
sure. Yeah. So it's just about double.
So yeah, for our marketplace, the FHA loan is there for some things, and that's why when we do a consultation with everybody, that we'll figure out which program is the best
Yeah.
for them.
I would recommend, especially in today's market where you're not going to get a house if there's a cash buyer competing against you, right? So let's make you a cash buyer. And the way we can get close to being a cash buyer is pre-approval.
Well, more than a pre-approval,
Yeah.
we can actually get a credit.
Approve you,
We
right.
can actually get a credit approval. If you provide all the documentation, all of the income and asset
Right.
documentation, we can submit your loan to an underwriter. They would review it, give us an approval, and the only thing you really need to do then is find the
Find
house
the
and have
house.
an appraisal that.
We did that recently in our office. We took one of my agents took their client all the way to the loan approval process. And then the only thing left was to go find the house. And there were bidders that were cash buyers. But my agent had the lender call the listing agent and say, this person has been pre-approved by us. They just need to find the property. They've been approved by us. Pre-approval, as you know, we all get pre-approval letters. They don't.
Right.
They mean squat, really, in most cases.
In most cases, but the way that we do pre-approvals is that if you're employed, it's fairly easy to know what your income is. If it's self-employed, I will very rarely issue a pre-approval
pre-approval,
letter
yeah.
without seeing their financials.
A lot of sellers don't know the difference between a pre-approval letter and an approval.
Right.
And there's a huge difference.
Yeah, there's a couple of different,
Yeah.
pre-qualification, based on what you told me, you'll qualify for X.
Based on what you told me.
You don't run credit, you
Yeah.
don't have anything. The
Yeah.
other is to do a pre-approval, which we would collect information from them and then run it through an automated underwriting system. And as long as we can verify everything in their application, we would be able to make that loan. And then what we would do, if we submit it to an underwriter, it's more than a pre-approval, it's actually a loan commitment that we would issue subject to an appraised value.
Right. And that's, again, we just did one of those recently, and the listing agent was so impressed. She said, I've never had an offer submitted before where the client was actually approved for their loan if the house fit the bill. And I've never had a lender call me ahead of time and say, this client's submitting an offer. I want you to know this isn't a pre-approval or a pre-qual. This is an approved loan if your property,
Right, if we have
fits
an
our
appraisal, if
and
appraisal
fits
comes
the
in.
appraisal.
And in this market too, if you have that situation, you can always have a buyer say, well, I'll come up with a difference in cash regardless of what the appraisal is.
Right.
Because that makes it more equal to a cash offer.
Exactly.
And I don't know, I mean, a lot of people think if I give you cash, I'm gonna get a discount.
Yeah.
But this offer is like, it's gonna take a little bit more time. Well,
Right.
probably not as much more time than doing
Not
a
if
cash
they're,
offer.
approved already.
Not
So
if they're approved
that was the other
already.
thing, that it's not your typical,
Would I wait 10 days to get $20,000 more? I would.
Yeah.
But,
Yeah.
and there's less risk if they're waiving the appraisal and
Yeah.
they're willing to come up with a difference.
yeah. And, something we haven't touched on is first-time buyers never think, usually, about buying a sort of an income property for their first, and I'm talking about a duplex, for example, or a fourplex. And first-time buyers don't always think about that.
Yeah. So on a multifamily, 2-unit, 3-unit, we can use the rental income of that other unit to help them qualify.
Right. And it doesn't usually enter their mind, wow, why don't I buy a duplex instead of my first home being a single family? Because now I have income to help make the payment, and that income gets, figured into my loan. And then, okay, what's my 5-year plan? Maybe in 5 years, I've saved up enough to go buy another home, and I can keep this duplex as, investment.
And it doesn't have to be a 2-unit. We'll do the same thing with an Ohana or a mother-in-law unit if that's being rented.
If it's legal, right?
Well, even if it's not legal, we'll still use that income.
Okay.
As long as it's something that we consistently can
See the history of the
it.
payments.
And we'll probably do a comparable rent schedule with an appraiser to determine what the
Yeah.
market rent is. That's another option we can do. Also, there's border income. If you're living with somebody and they're renting a room from you, and we can document what that income, that rental amounts are that you're paying, or your boarder is paying to you, we can also consider that income as well.
Bottom line is seek out professionals that know what they're doing, the realtor and lender, because there's options that may have never occurred to you. And as a realtor, I can only say you need to own your home. And what basically I want to get you to the point where you have income property and somebody else is paying the mortgage on it for you. That's the end goal. Where else can you go and rent something and the landlord say to you, okay, this is your payment for the next 30 years? Nowhere. With your first time home, if you get a 30-year loan, fixed rate, that payment is your payment for the next 30 years should you choose to live in that property for the next 30 years. And at today's rate, the lowest in 50 years and maybe more, your payment is going to stay locked at that low rate.
Owning is always better than renting.
It is. So thank you for joining us today, Jim. Thank you for your insight.
Thank you.
Aloha, everyone.
Aloha.